Hello and welcome to FATCA Reporting. Are you prepared? I would now like to introduce your presenters for today. Lawrence Kittle, Managing Director of Thomson Reuters Tax and Accounting Business, EMEA. This role includes ownership of the Thomson Reuters for FATCA Solutions. His previous role was Commercial Director for FATCA at Thomson Reuters, where he was responsible for delivering the Thomson Reuters FATCA solution, which brings together market-leading software from the governance, risk and compliance, and tax and accounting divisions in an end-to-end FATCA compliance package. Lawrence was previously head of indirect tax compliance operations, leading a team focused on designing and integrating tax technology solutions. Prior to joining Thomson Reuters, he worked at Arthur Andersen's and Deloitte mainly on process and tax technology consulting projects. Lawrence is a chartered tax advisor and holds a master's degree in information processing. Tom Shaves, Director of Deloitte, at Tom's current focus is on tax reporting requirements for financial services institutions with a particular focus on FATCA. Tom has led a number of FATCA engagements for a variety of multinational financial institutions in the UK and Europe, including a number of banks and investment managers. These have ranged from impact assessments through to full-scale implementation projects. Tom is also sitting on one of the HMRC working groups considering the implication of FATCA in the UK. He is also a member of the OECD CRS working groups consider the implication of the automatic exchange of information. At this point, I would like to turn the floor over to Tom. Tom, please go ahead.
Thank you. Hello, everyone. What I'd like to take you through today is to give a bit of an overview of where we are with the current global information exchange landscape, with the FATCA regulations and how they're moving forward to a more global automatic exchange of information mechanism, and how that will affect financial institutions and what the key areas they should focus on. So the last 3 years, we've seen a significant amount of change in this field. Tax authorities have identified that financial institutions hold a lot of information on their customers and investors, and they want to get access to that information. This started with the introduction of US FATCA by the US, and has subsequently progressed for other jurisdictions to see whether they can introduce similar types of legislation. For example, the UK has recently introduced agreements or intergovernmental agreements with their Crown dependencies, so that's Jersey, Guernsey and the Isle of Man, and the overseas territories, so the likes of Cayman, BVI, Bermuda and Gibraltar, to also exchange information. What the tax authorities are looking for is for those financial institutions to undertake due diligence on their customers and investors to identify certain categories of persons that they are interested in further information on. So under US FATCA, financial institutions are required to report on US persons, and that's both individuals and businesses. And then under UK FATCA, financial institutions are required to report on UK persons in one of those jurisdictions I mentioned earlier, and those agreements are actually reciprocal as well. So UK financial institutions will also be required to report on, for example, Jersey or Guernsey persons. This regime and mechanisms that have been introduced are seeing no sign of abating. So just yesterday, the OECD announced that 51 countries had signed up to a global mechanism of automatic exchange of information. And that framework is called the Common Reporting Standard, or CRS. Effectively, what that means in practice is that financial institutions will be required to report on nearly all their customers and where they are tax resident. They will report that information to tax authorities, and then the tax authorities will share that information between each other and provide greater transparency on those customers and investors and where their tax residencies. they want to use that information to actually follow up with those businesses and individuals against their own tax liabilities and ensure that any tax evasion can be tackled. So we've seen a real change in the landscape of information exchange over the last 3 years, and I think it's continuing to grow. And that really poses quite a burden for financial institutions that they need to consider about how they're going to deal with going forward. So just to give a bit of an overview on the timing of FATCA and CRS. So UK and US FATCA went live certainly in the UK from 1 July 2014. There was some concessions given in some jurisdictions for entity reporting for US FATCA to 1 January 2015, but most countries have actually seen FATCA go live now. The first reporting is kicking off in 2015, and there's a variety of dates which I'll go onto in a later slide on when financial institutions are required to make returns. That information will be required to be reported on information in respect of 2014, the second half of 2014. The announcement yesterday in Berlin around CRS was around the early adopters actually introducing the Common Reporting Standard. And the go-live date for that is 1 January 2016. So from that date, financial institutions will be required to collect information on their new customers around their tax residency and then report on that information from 2017. As I said earlier, 51 countries have signed up to that agreement yesterday, and a number of other countries have committed to the introduction of CRS from that date forward. So some are starting in 2017 with reporting in 2018. Some of the other dates that I've just identified on this slide are around when the due diligence is required to be undertaken with respect to the pre-existing customers, i.e. those customers that were on financial institutions' books before the regimes went live. So I just want to spend a little bit of time just focusing on what does FATCA mean at the moment, and what do the CRS requirements have impact for financial institution. And this slide, I've just taken the example of a UK financial institution. So taking the top box firstly, we've got a UK financial institution with a Jersey customer and a US customer. For US FATCA, that UK financial institution will have to identify that US customer, and that can be through a self-certification, for example, and actually report on that customer to the local tax authority. They report to a local tax authority because the UK has signed an intergovernmental agreement. HMRC then pass that information to the IRS on that US person. The UK financial institution in this example has also got a Jersey customer. It's required to identify that Jersey customer under the UK Jersey agreement and again report that customer to HMRC. HMRC then passes that information to the Jersey tax authorities. So that is the current state that we have at the moment under FATCA. Now under the IGAs, under a Model 1 IGA, financial institutions report to their local tax authority. And there are over 100 agreements now either signed or initialed. Looking forward now to CRS, the financial institution will have a much more significant burden. So I've put in the second box, we still have the US customer, and now we have a Jersey customer, German customer, and a Mexican customer. That UK financial institution will be required to identify all of those customers, again, potentially using a self-certification form, and report that information to HMRC. HMRC then passes that information to the relevant tax authorities, whether that's the IRS in respect to the US person, and then the Jersey, German, and Mexican people get reported to their respective tax authorities. One of the interesting points just to draw attention to here is that the United States hasn't actually signed up to the CRS as an early adopter. So FATCA will still be in place at the same time as the Common Reporting Standard. However, the US has said that they will implement automatic exchange of information under their existing intergovernmental agreements. We can see from these two examples that there is an existing burden under FATCA for financial institutions, but that is going to grow significantly for financial institutions under the Common Reporting Standard. And that exponential increase requires financial institutions to start thinking about how they're going to deal with that. So just moving to the next slide now, I just want to spend a little bit of time talking through what some of the deadlines are and the information to be reported. So under the FATCA regulations, there is certain information that needs to be reported in respect of each reportable account. So under US FATCA, that would be in respect of each US reportable person. That information is required to be reported in respect of the year-end position of that customer or investor by the financial institution, and they report that in the following year. As I said earlier, reporting would be via the local tax authority if it is in an intergovernmental agreement jurisdiction. Just outlined at the bottom there the date for when the reporting kicks in. So we're rapidly approaching the first reporting deadline for financial institutions in respect of FATCA. That comes in March, between March and June 2015, and different jurisdictions have come up with different dates. Financial institutions will be required to file the returns in respect of their US customers in 2015. In respect of UK FATCA, which obviously only applies to those certain jurisdictions, the reporting is actually in 2016. So the authorities have given 1 year leeway. However, they are still required to report on the tax years 2014 and 2015. And then for the Common Reporting Standard, the first reports for the early adopters will be made in 2017 in respect of 2016. Just moving on to a little bit more detail around the type of information that will need to be reported, and this is in respect of FATCA. So I've set out on the left-hand side there the information that will need to be reported in respect of each reportable account. So the name, address, TINs, the tax identification number, account number, and account balance are required to be reported in the first year, along with the reporting financial institution's GIN number. Each jurisdiction has or starting to release schema in terms of the precise format that needs to be reported, that those elements need to be reported in, and I'll go on to talk about that in a little bit more detail in a moment. That information is reported, as I say, in the UK in May 2015. There's then phasing in of the information that needs to be reported. So from 2015 onwards, you have to report payments, and then we set out there the type of payments that will need to be reported, and that will depend on the type of financial account that the account holder holds. And then that moves on to include gross proceeds from 2016 onwards. Interestingly, under the CRS, there's no phasing in of the information around payments. That's all being implemented from day one, so from the first reports that will be made in 2017. Financial institutions will also have to report on aggregate payments made to non-participating financial institutions for 2015 and 2016. This next slide just sets out a little bit of detail around the schema and the types of reports that need to be filed. So under the US regulations, the expectation would be that a Form 8966 will need to be filed, and there is a prescriptive format for that to be submitted in. and then each country that signed a Model 1 IGA will define its local schema. Generally, that's going to be very similar to the wider schema that has been released, although there are some key differences. Model 2 jurisdictions, which again will be filing direct to the IRS rather than to the local jurisdictions, will again file a Form 8966. Just to talk a little bit around what HMRC have done, given that they are the furthest ahead in terms of the jurisdictions that have filed and set up their reporting schema. They've recently opened a portal for financial institutions to actually register, and there are some various screenshots I've set out there which give some information on what financial institutions would have to actually submit and how they would upload that information. There are, although the IRS had a registration, HMRC have an additional requirement for a user ID to be obtained to enable a file to be made in the UK. And we expect each other jurisdiction to come up with similar formats for their files to be made. And I know a number of jurisdictions are pushing ahead with that. I just want to finish now on just talking around some of the challenges that financial institutions are facing with respect to reporting. So the requirements that have been set out are becoming clearer, I think, in terms of the precise information that needs to be filed. However, this schema is still continuing to emerge from the different jurisdictions. We've only had a small number of jurisdictions actually come out with the schema that actually needs to be reported. The other thing to note is that just the burden of returns that it will need to be made is potentially quite significant for multinational financial institutions. Every financial institution that actually has a GIN number, has registered with the IRS, will need to make a submission, and that potentially is quite a lot of work to identify what they need to submit in terms of their reportable accounts, and then how they're going to go about that. And managing that across the globe is potentially quite complex. In addition, there are likely to be some local variations which need to be managed, and actually dealing with the different timeframes where each jurisdiction have come out and required filings to be made can also provide a challenge. FATCA is just the start, and the CRS is going to provide even more potential challenges for financial institutions. So we would recommend that financial institutions consider how they're going to approach reporting now in preparation for this common reporting standard requirements that are going to come in. I'm sure Lawrence will touch on that in a bit more detail. Just to finish on my contact details, and then I will pass over to Lawrence to take us forward with his presentation.
Great, thanks, Tom. That was excellent. I think also very timely given the OECD's announcements yesterday. I mean, this is literally hot off the press. So
yeah,
it's coincidentally it's great timing.
Yeah, it's been great timing, and I think the OECD signing the agreements yesterday will really make a big difference in pushing countries forward to release local guidance down on what the CRS means in practice.
I think so. I mean, one of my themes is going to be uncertainty. I think this removes a little bit of uncertainty, but I think creates a bit more. So it'll be interesting how that plays out. Now, I'm going to go through and actually talk through some of the practical challenges and perhaps how we can mitigate some of those. Before we do that, though, we're actually going to go through a couple of polling questions. And this gives us a sense to kind of gauge audience reaction and also to help us guide the further discussion here. So there should be two now on the right-hand side of your screen. They'll be on screen for about 30 seconds. So questions are, one of them picking up on Tom's point on self-certification. Where is it required under an IGA and now looking to CRS as well? What's your preferred approach? And the second question there, so we've been looking at FATCA for the last 3 to 4 years or so. We're kind of in a FATCA plus world now, if we can go call it that. How easy is it to change what we've been doing for the last few years to reflect CRS, UK versions of FATCA and whatever else is coming down the line? So just a few moments to complete those would be appreciated. We'll actually see the results coming through almost in real time on this. So that will then give us a guide as to how we can put the further discussion. And while we wait for that to come through, so what I'm going to cover in my section of the presentation, maybe for the next 15, 20 minutes or so, before we do move to pick up questions, and please do use the chat facility to put those through, is really three main areas. So I'm looking at practicalities, but really looking at the process of going through reporting from data through to the actual submission and see what steps are practical to apply there. Also going to look at specific pain points. Tom's picked on a few of those, and I just want to put a bit of a gloss and a bit of extra detail around that, perhaps. And I'm also going to look at options for compliance. So what's the best way to do this? Do you do it yourself? Do you outsource? Do you build? We'll cover some of those. And just actually to glance at some of the results that we have here. So self-certification, I think we're still looking overwhelmingly actually at a W8 world. We're looking at a significant amount of self-certification. What is interesting here, right, is we've actually asked this question at two previous webinars, back in January and also in August of last year. Even in January of this year, the don't knows and not sures were up around about 25-30%. I mean, there's a massive reduction in that. I mean, that's encouraging, I think. We've obviously chosen things, and I think Tom, you probably see his practical experience as well.
I think it's also interesting just to see that W8s are still 50% of the results coming back, and though self-certifications are getting close to 30%, I would expect that the self-certifications proportion will continue to increase as financial institutions consider how they're going to deal with the common reporting standard obligations that they face, which are jurisdiction neutral rather than being focused on a US angle.
It's an interesting point, actually, and one of the things we've been building recently is kind of a W8 plus approach, which takes a W8 format, but actually includes includes questions around tax residence, perhaps, which aren't included on conventional W8. So aiming to cover, in old terms, US Chapter 3 and Chapter 4, but also future-proofing to a degree. Anyway, that's great, and there may be some questions that come out of this that we can return to later on. So I'm going to go through looking at the practicalities, and really, we're looking 2 or 3 years ago, and we began putting our FATCA solutions into the market. Reporting was kind of at the back of our minds. It was all to the IRS. It wasn't a big deal at the time. I think now it clearly is. We've got 100 plus IGAs of various guises, either signed or imminently signing. We've got 51 countries signed up immediately to the OECD for CRS, with a further, I think, 58 committing to 2017 plus more beyond that. I'd just like a couple of the quotes here. So Douglas Schulman originally said we had a significant undertaking. The global custodians upgraded this to very substantial, which I think, given the staid nature of a lot of financial language is pretty impressive. So it'll be interesting what the phraseology around this is now, I think. It's a problem, I think we can safely agree. So there's an issue. So how do we look at resolving of reporting specifically? And what I did here, I took a fairly abstract look at what a business would have to do through a reporting process. And where I came at this from, really, and the way that we've had a lot of discussions both with our customers and with our advisors, is that at base, FATCA reporting is not so different to most other tax processes. I mean, basically, you get some data, you manipulate it, you validate it, you adjust it, and then you submit. And I'm reducing a huge amount of complexity to about 6 words. But if you actually strip everything back, I think that's what you come with. And one of the approaches I like when you've got something new is to kind of look to lessons of the past, and actually an explicit example of this as we go through the presentation. But I see this as kind of similar to tax information reporting in the US. So, 1042s, 1099s use substantially similar information with a massive proviso. There's no multinational element to that. So that's one half of the picture, perhaps. The other, and this comes very much in my background, is looking through things such as listings reports, such as the European sales list and the Intrastat we have to submit through the EU. And what you have there is a lot of transactional level information that has to be reported to many different authorities, but obviously very different information. But I think putting those two together, you arrive at a kind of process that we're looking at for FATCA. So while this is new and while CRS is massively challenging, I think you strip it back to what underpins it, it becomes something a bit more familiar. And I think that's certainly formed our thinking. I think, Tom, that's probably
Yeah, I agree.
Similar from your side as well.
Yeah.
I mean, looking at FATCA specifically, I think we put this to a 5-step process. And we're looking there around collecting data, around validating it, around creating reports, how we review and amend this data, and how we actually go through, resubmit and file. And it's worth actually looking at another question at this point as well. So we talked a bit around the rhetoric around how much this is costing. Well, we know it's a lot. There have been a lot of surveys. But a couple of polling questions here. So what's the expected spend in your business? And looking back to original budgets, how close are you? Is it above? Is it below? I think if I was answering question 2 for Thomson Reuters, it's a bigger undertaking than we set out. And I think the whole problem has become bigger. So I think we're firmly in option A on the second one there. It'd be interesting just to get a reaction again from the attendees on where we fit with budgets and where we fit with the actual overall spend. So looking at the 5-step process around data collection, validation, reports, review events, submit and file, doesn't sound too challenging. I think we obviously know that there is a huge amount below that, but just looking at how that translates to a bit more detail perhaps. And I won't dwell on this massively, but the conversations we've had over the last 6 to 9 months or so point to big issues around many data sources, around multiple data outputs, and the operations that you see within that. I think probably an absolute time to look at the results from the survey there, I think, and what have we got? So we've got, on budgets particularly, congratulations to 9% of you that are coming in under the budget. I think we can all learn from that. It'd be great to see how you managed it. A lot of people in the Thomson's camp there, plus 55%. I won't ask Deloitte, but I think that's a... but yeah,
I think that's a general trend we see in the industry, though, that the budgets have been exceeded, and part of that's been driven by some of the delays in the regulations and how they've been implemented through IGAs and the challenges involved in that. And I guess with DRS, budgets will need to continue to be extended to deal with those things as well.
I think we're now solving a different problem to the one that we had 2 or 3 or even a year ago, and I think that's part of the challenge there. And just looking at what we've got on the solutions map here, a year ago, okay, there's many data sources on the left-hand side. There's a lot fewer outputs on the right-hand side actually going to national tax authorities, and there's probably less operations happening in the middle. There's a more consistent set of validations. I mean, one of the interesting things with CRS is just what we do with the data once we get it. So what level of business rules are put around it. I just put this here as a schematic. We'll return to actual discussions around how compliance can happen and whether that's in-house builds, whether that's software purchase, whether it's pure outsource. So I think that schematic there of data coming in, the manipulation, and the many different outputs, as Tom flagged earlier, coming out, is always going to be an interesting dynamic. Okay, so look very briefly at the problem as a possible process for resolving. Let's have a quick look at some of the pain points. I think Tom flagged these very nicely earlier in his presentation. I was just going to pick out 4 specific areas around this. I say we've had a number of customer engagements on this. We've consulted fairly widely, both with existing customers, with other people we speak with, and with Big Four and other advisors. We see 4 key themes coming out here, and going clockwise around. We've got the issues of operating in multiple jurisdictions. Now, filing in many countries is always painful. We've got the risk management involved with going into something new and very high profile at the moment. We've got the data spaghetti, perhaps, of dealing with many different data sources, trying to untangle that. And then we've got, well, Donald Rumsfeld himself isn't specifically a FATCA pain point, but it's a point about managing the unknown. So you've got old Rumsfeld's famous speech about known knowns and unknown unknowns. I think we've flagged earlier, there remains uncertainty. Despite 50-odd countries signing up, we kind of know what they signed up to. We don't quite know how they're going to operate that. So that's interesting. Let's dig into each of those a little bit more detail, perhaps. So looking at multiple jurisdictions, and Tom covered a lot of this. I won't go through in huge detail, but we're looking at differences in data collection. You've got different requirements and different validations, even on self-certifications in countries, whether you're make date of birth a compulsory field, for example. So that presents a challenge, I think. We don't expect the electronic filing formats to be absolutely consistent across all countries. In the UK, we use a certain method that's not used everywhere else. So XML is the standard, but that's not going to be absolutely prevalent. And the same goes for report formats. I think some countries will ask for additional information, even if it's just checkboxes around whether it's a nil return or whether it's applying de minimis limits as HMRC are doing in the UK. So I think you've got potentially filing slightly different data, which leads to reconciliation issues potentially. And I think you've got the future. Tom mentioned this. There's a lovely schematic showing reports going out to many different countries. If you've got someone with multiple indicia, multiple tax residencies, you've got, maybe we'll come to that questions later on, but potentially you're filing on behalf of one person many times, which is an interesting place to get to, I think. So a lot there to dig out around the multiple jurisdiction angle to this. I think looking at risk, a lot of this is self-evident, I think, but you're looking at, there's a reputation aspect to this. I think what is interesting is that we don't often know how tax authorities are going to respond to any perceived misdemeanors over this, whether reporting deadlines are missed, how audits are going to get conducted, what kind of audit protection you need to put around that, and even how consistent this would be. So if you are filing under multiple IGA countries, does an audit in one trigger an audit in another? How joined up will the tax authorities be? I think this is going to be an interesting point to explore. We see with VAT the potential to do this for a country to audit multiple countries, but in practice it's incredibly difficult to achieve. It's going to be very interesting how that plays out over the 3 to 5 years of when it's initially rolled out. I think you've got a customer concern here as well, perhaps. You want to report the right amount of data, obviously. You don't want to over-report. If you're reporting potentially for a customer that shouldn't be reported, that's also an interesting situation there. And I think perhaps the question we return to later on is, should you actually inform the customers what you are reporting? And I think I think it's coming up through the chat anyway, so we may well return to that question at some later point. Risk is a very big topic. It's always at the forefront of our minds, and I think there's a few specific issues around new regulations which we'd need to address and pick out there. Complexity I've mentioned. You've got to find data first of all. That's not always immediately obvious. You may well have transactional data when that's required, and account information in totally separate systems, for example. Getting that together with a common identifier is necessary, but perhaps challenging. I think data integrity. So, we have one customer who had a nationality as a required field. You think that kind of solves the problem, apart from 53% of entries in that were unknown. So it's not massively helpful in that situation. So it's not enough just to have the data, you've got to do something with it. And as Tom flagged up, requirements are going to change over time. The data for FATCA builds and builds and builds on itself. For CRS not. So, do you go big bang at the start, do you build up your own data libraries over time? I think, no one answer, but interesting dynamics. I'm aware I'm posing lots of questions, not really answering them, but I think perhaps we'll pick some of that later. And uncertainty, Ramsdale talks about the unknown unknowns. They're becoming slightly clearer, but there are still unknowns here. We don't know how exactly enforcement's going to happen. We don't know all the details of CRS. I think FATCA we're fairly clear on. I think we know what we're doing broadly. IGAs are fairly clear. But how it's going to evolve in the future when you've got timelines going to 2017? I think one thing FATCA has taught us over the last 3 years or so is that things change. It's not what you see now is not necessarily what you have in the future, and having flexibility in programs is important. And just briefly now, looking on to how we begin to resolve some of these problems. So looking to solutions, and broadly, I think there's 3 options here. And what we've got, again, clockwise around here, you've got the option to build a solution. Got nice builders up there. You can go out to the market, literally in this case. There's third-party solutions. Or you can bundle it all up and outsource it. And I think each of those are good, interesting options, which we'll spend a bit of time discussing. There is perhaps a 4th option, actually. And I mentioned learning from lessons of history. We've got Admiral Lord Nelson here, the Battle of Copenhagen. And apologies to any Danes who are on this. This isn't meant to any nationalistic point here. But famously here, turning the telescope's blind eye. I see no ships. It is possible to ignore this, but it's probably not very sensible. I'll just flag a quick polling question here as well. So we flagged 3 main options, I think. We can apply the Nelson option if you like. But the questions are, where you need a technology solution for reporting, what's the preferred approach? So is it an in-house build? Is it a combination of buy and build? Is it a third-party solution. I mean, what are we looking at this? Or is it just outsource it and return to it later? And the other option here, you know, we didn't want to go down a Halloween scare story. We're a day too early for that. But deadlines phase in from March. How confident as businesses are we that we're actually going to hit these deadlines? You know, we're going from very to not, or not sure there. And see, from the Voice's point of view, we're absolutely on this. We got out there, and I think Tom would say the same from Deloitte's advisory. But I think there's dynamics to play out on that. So we just let those questions go through. I mean, ignoring seriously, it has been flagged as an option at a couple of seminars that I've participated in, and it's not really an option. You know, the prospect of losing out dollar markets isn't really there. But, I couldn't resist the picture. Now as those results come through, just to look at some of these options, I mean, there's pros and cons each way, and there's never a one-size-fits-all answer. Looking at in-house builds, perhaps, you get a lot of benefits around flexibility. You own it, you control it. It can be tailored to a specific situation, and you don't have to spend externally. Other questions there, though, you know, is a bank, a financial institution, a hedge fund necessarily the best place to be developing software? I think, you know, there's areas of expertise, and sometimes it's best to follow what you're best at. Ongoing maintenance is an incredible drain. You know, we've seen this many times. You can set something up, but actually maintaining it over time can be very difficult. And a tailored solution doesn't always remain tailored. I think that's a reality there. Just look through the other two options, and then we'll return to the results on this. I mean, looking to going to a third party, well, effectively you're outsourcing risk. A third party takes on the risk to build the maintenance, keeping it up to date. You can benefit from the global scale of many providers, and while you lose the inherent flexibility of having a tailored solution, they can be configured in implementation. So there's a lot of benefits in having something that flexes the process. And costs are known. You know what you're doing. Flip sides to that, you know, you want to choose a vendor, a partner that is there for the long haul, not a small business popping up, perhaps introducing vendor risk to it. Business needs don't remain static, so you need the investor solution is going to flex along with that. And I think what you look at there as well is actual control over direction. You know, you can feed into product management, you can feed in through customer relationship managers, but obviously a third party has a certain direction. And I think there's vendors that have been on the market for a while. We've had our solutions out around VAT, tax information reporting. We've been there, we've done this, we know it's difficult, and we know that getting solutions out there is challenging. And then outsource, you know, this can be a very attractive option too. It's time efficient, just get it out there. It reduces internal resource requirements. It does take away technology risk, but it does mean dependent on third parties. You reduce in-house expertise, which can be an issue, and it does cost, obviously. You know the cost, but it made as a recurring cost. I think let's just pick out the answer to these survey questions, and then Tom, perhaps you'd like to have a quick crack through this as well. So we're looking at an interesting mix, actually. So a mix of in-house and third-party solutions, around 40%. Compared to if I'm outsourced at the moment, I think my guess is we see that changing. I looked at what we did with XBRL, perhaps, and that was...
Yeah, I think from our perspective, just what we've seen in the market is various financial institutions are trying to work through what their solution is going to be at the moment, and particularly for some of the multinational financial institutions who have got to manage filings in a lot of different jurisdictions on different timings, the prospect of outsourcing can be attractive because just managing how you're going to ensure that each financial institution has made a filing and with the correct schema can be complex, and otherwise if you look to do that in-house, just the project management of it will take up time. The other angle, of course, is the expertise and having the knowledge of the validation checks that you'll have to do in each jurisdiction, and whether you'll need external support for that as well. Yeah,
I think that's an excellent point, actually. I think this comes through both outsource and through third-party builds. So you're effectively, I don't want to use the term back, but it's almost like you're crowdsourcing knowledge for this, that you're looking at best practice across a very wide basis. In-house, you've obviously got deep technical expertise in your field, which is invaluable, but perhaps lose that slightly wider view across an industry in general. I mean, is that a fair comment?
Yeah, I think so. And as you rightly pointed out, Lawrence, there's a lot of change in the market at the moment, just from the regulatory point of view. So the burden under FATCA perhaps is going to be manageable because the number of accounts or the percentage of the total of customers and investors that you have to report is going to be quite small. When we look forward to CRS, and you could be potentially reporting 70-80% of your customer base, that is a significant change, and you have the risk, I guess, of investors and customers wanting to understand what's actually being reported, and financial tax authorities following up with those investors and customers, and how you're going to manage those queries is quite a burden as well.
Yeah, that's absolutely right. And I think perhaps we're a little bit too prescriptive in the options that we give here. That there's one organisation we were speaking to just this week where basically it's the choice is all three. There's an element of in-house build over data collection, which is from many, many different systems. There's an element of a third-party solution in just looking at the filing itself, just shipping, consolidating, getting stuff out to the authorities. But they also got an enormous number of nil returns, which they were looking to outsource, and see a very, very low risk but low value in doing the nil returns in-house. So it is an interesting combination.
Yeah, and I think it's interesting that people are confident that they will make the deadlines. I guess there's going to be quite an intense period of work over the next few months to actually make sure that those returns are filed on time and correctly.
That's right. And there's a point I mentioned earlier, actually, the IXBRL, which looking to the UK was a similar-ish area some years ago. Legislation came in, it changed very quickly. I think what we saw then was a combination of outsource, in-source, often outsource to fix the process and then bring that back in-house later on. So I think there's never quite one size fits all, which is interesting. It is good to see just so many people confidently going to hit this, though. I think that's exceeding my expectation, which is tremendous. On three at the moment, I've got a few decision points around the build by in-source, outsource debate. This by no means a prescriptive list. I think it does come down to internal capabilities. It comes down to a view on cost, and actually, I think if you're looking at operational expense versus capital expense as well, that very often outsourcing is operational expense, which is relatively easy to get through. Capital budgets don't need to be agreed and signed for. I think business priorities, where do you want your staff spending time? Is it on serving your customers and the wider tax community, or is it on putting together house solutions? Many businesses have a strategy around this. Some very big banks will always build, and I think that's a decision they made over many, many years. And the other option is the landscape. Are there vendors, are there outsource providers out there you trust enough to do this with? So I think these are some questions, but there are many others. I think this is just here to provoke thought, perhaps, and to provoke the debate, but there's certainly different ways to approach this. That, I think, was as much as I was planning to go through on this. I know there have been a lot of questions raised through the floor as we've gone through this. So should we cut back and look to some of the questions now, please?
Yes. Our first question, impact of yesterday's announcement on current plans. Should we change tact? Lawrence?
I'm actually going to defer to Tom, I think, on this one, as I believe he was actually present and engaged in a lot of the discussions there. So
yes, thanks, Lawrence. I think it is going to be a significant change for financial institutions in terms of the volume of reporting that they will need to undertake. I think working with many financial institutions across the globe on dealing with their FATCA obligations over the last 2 to 3 years has shown that it has been challenging to get in place the processes and procedures to ensure compliance with FATCA. And recently I've seen a bit of FATCA fatigue almost, that financial institutions have felt they've got through the go-live date and starting to think about reporting and then need to gear themselves up. I think it's important to think as financial institutions move into 2015, how they can continue and roll forward their FATCA programs and adapt them into a broader automatic exchange of information program to take into account the Common Reporting Standard. There are many common elements between FATCA and CRS, so it's not a whole-scale change, but they should look to see how they can future-proof any of their current operating procedures to ensure they can be compliant with the Common Reporting Standard. I would just note, although the agreement was signed yesterday, we are waiting for each jurisdiction to release the guidance and regulations in each of their own jurisdictions on how they will implement the CRS, and that will take some time anyway. So it's also keeping a watching brief of local developments.
Yeah, I think that's actually a very good point. I mean, it clearly has an impact, but it kind of confirms what we knew directionally was happening anyway. I think the thing that's been perhaps challenging for us as providers putting reporting solutions out there is that you're working with imperfect information very much of the time. And you know directionally where you're going, you know broadly what you're submitting, but a lot of the nuances we're still waiting on, and that's things like exactly how the scheme will be validated in different countries perhaps. It's around the level of what business rules you want to put through. I think the point relating back to the question here is just how much you build, it's set in stone at the beginning so much, and how much you just iterate as you go through. I mean, the approach we've taken is that we go through a fairly base rule set to start with, and then just build up and build up and build up on that, and expect that is always going to be changing. So the question whether you ever get a final solution, I don't think we ever do with this. I think we're going to continue to evolve, certainly to the end of the decade, I would say, and probably beyond there. It's interesting. And it is a good question, right? But I think you deal with what you know. You kind of mitigate what you don't know. And if it works, working with providers to help with that, who can take that risk on, then that can be a very good solution, I think. It's a good question, though. I think we've got a few others, and we've got about 10 minutes or so to get through. So can we move to the next one, please?
Yes. When should you have made a decision on when you're going to report? Outsource, insource, buy, build?
So that's a kind of question I think over when you need to get a program in place, when you make your decision and when you actually go through. I mean, my sense is businesses are doing this already. The correct answer is probably yesterday, but I don't know, even Tom.
Yeah, I guess, just going back to what I was saying earlier, really, financial institutions have been dealing with, many of the implications of the go live date. So, a lot of we've seen a lot of self-certification forms being required to be completed. Also the W8s, W9s, and that's raised a lot of queries in the industry more generally. And I think now attention is turning to the reporting and how the reporting will be managed. I think financial institutions probably have a reasonable understanding of what needs to be reported. It's the how, which I know, Lawrence, you touched on. And I think really by the end of the year, financial institutions want to be confident in what their approach is going to be, so that they are ready to extract the information that they need to at the end of the year and then file that in sort of Q1, Q2 next year.
Yeah, I think the point you make there about this is not necessarily a single decision. I think there's steps along the way with this. So, you want to break it down. Part of it is identifying the source data, getting that right, which I think you can do now. I think there's looking to gather, consolidate, validate that. That's the second stage. The actual submission part of it itself, where there is very little known, is probably very much further down the line. But that's the kind of thing that can wait, because if we're looking at the eventual point on whether you build, whether you buy, well, if you're going to build, you probably should have started by now, frankly. I think there's a lot to do. There's a lot of information to get, a lot of data to process. So in-house build, I think, probably should be at least specified and moving. I mean, if you're looking to either outsource or to go to a third party, then, review your options now, right? But I think decisions can be made over the next few weeks. My sense is by the end of the year, I think at least directionally, if not fully signed, sealed, delivered, most businesses are going to be reasonably settled in their approach. And that's, I think when you're looking at software as well, you have got practicalities, right? And I think, we've got very often a software freeze comes through November, December time, where it's very difficult to get new technology into a system. Very often in-house technology is tied up through the year-end period as well. So practically, I think you make buying decisions that may not be implemented until very early next year, but you need to be at the point really where that's going through now. I hope we've answered that one anyway. I mean, there's quite a lot tied up in quite a short question. Can we move to the next one, perhaps?
Yes. Should FIs tell their investors that they are reporting, and if so, how?
Good question, actually. Yeah. I've seen a divide between Americans and Europeans on this, actually. You know, it's where you're used to submitting 1042Ss, etc., then I think American banks are more likely to. Maybe Europeans not.
Yeah, I think there's a bit of a mixed situation, and people are still trying to determine their approach. That, you know, obviously this affects, you know, FATCA affects a broad spectrum of financial institutions, from banks, insurers to funds as well, and probably a little bit of a few different approaches depending on which industry you're in. Interestingly, under the Common Reporting Standard, there was an announcement a month or so ago from the EU Commission announcing that they were looking to implement the CRS in Europe, and one of the things that means is it interacts with data protection. And in the EU, the data protection says that potentially customers and investors have a right to be informed that they are being reported to tax authorities, and that might lead to a move as an industry trend that customers and investors do get told that they are being reported on. And I think, again, that would mean that there's a bigger burden on financial institutions, because they will not only have to manage the returns that they make to the tax authorities, but also then manage the returns that they make to investors and customers.
Absolutely. That's a good answer, I think. Next question. Do we have one to get?
Yes. U.S. FATCA allows FIs to elect to apply thresholds for pre-existing accounts. Has the process for election been published, and if so, where?
So just on that, I guess there's a pre-existing threshold for different customers, and that will be applied in each different jurisdiction depending on whether there's an IJ in place. And the procedure for doing that will be actually outlined in local guidance or regulations. In the UK, for example, there isn't going to be a specific election that you make. That you would make that election as part of the return that you make at reporting.
Yeah, I mean, nothing to add there. I think it will vary, but I think yes, the next one, thanks.
Yes. Can you talk a little about the actual reporting methods? Is the 8966 a paper form, and the XML method more for multiple entities that just would not be possible on paper?
Yeah, I mean, it's a good question. The IRS were very good publishing a form, I think, relatively early through the process. I mean, the assumption we've been working through, though, is that is informational, that the filing will be by XML. There are portals, I think you can put manual information through, and I think, Tom, perhaps you're probably closer to some of that than me, but I mean, our entire focus has been around putting the electronic forms and the gateway submissions in. We cover paper forms for many other tax products, including for VAT, for GST and the rest of it. We are not planning to submit paper forms through any of our reporting offerings. I mean, Tom, if you add any gloss on the more multi-jurisdictional side of that,
I think the expectation is that it'll be electronic filing, and just in terms of the second part of that question, each FI will be made to file a return for that FI. And Lawrence touched on the point earlier around nil returns. So if you don't have any reportable accounts, you may be required to file a nil return. Again, that might vary from jurisdiction to jurisdiction.
Yeah, and actually, I mean, there's a very similar question actually has come through that, which we're just looking at here as well, which is around HMRC putting their web portal together. The Irish Revenue saying they'll only accept XML. And the question is, what do we expect from the other tax authorities, and when will they when will they announce their intentions? I mean, my take on that, I think we get the information when we get it. I think there's not an awful lot more you can say on that. If you look at other taxes, particularly within the European Union, you'd expect a reasonable degree of similarity between countries. very often you don't actually find that. I mean, the way that most German multinationals file, for example, is very different through a very different system, the ELSA system, to the way that HMRC does through the gateway. My sense is you accept and recognise national differences on this. And the way we've been putting our solutions together is very much based on that. And again, from the OECD level, I don't know if you've any view on CRS.
I think the feeling is that they want to try and keep the schema consistent and the implementation of CRS consistent. But again, it will be down to each jurisdiction to implement their own system.
It depends how you cut consistency, I think, as a general point. I mean, you'd look for consistency perhaps across taxes within a country. So HMRC would expect the same submission method for FATCA as for all of the other UK submissions. You can equally make the argument you go broad across countries and say, well, actually, it's CRS, FATCA, it should be the same everywhere. You know, we live in a slightly imperfect world in this case, and it's you're not always going to get there. I think we're very close on time. In fact, I think we are right at the top of the hour now. So, I mean, I just say thank you very much for the questions that have been submitted through this. I think they've been excellent and given a good debate. I think Tom and I can probably carry on for the rest of the day. I'm sure there's many people with other things to do, perhaps, not necessarily better, of course. I mean, Tom, thanks very much. Any closing comments, remarks from you, maybe?
Thanks, Lawrence. I think the world has changed significantly over the last 2 to 3 years. Is continuing to change, and the next big hurdle will be the reporting. So thanks very much for everyone for listening.
Great. Well, thanks, Tom. Thanks, everybody. Enjoy the rest of your day, and we look forward to speaking soon.